Hi, good afternoon, everyone, and welcome. My name's Steve Torsa. I'm the founder and managing director for Wholesale Investor. I'd like to welcome everyone to this workshop and to this webinar. You know, for me, to give you some context as we sort of kick off, the reason I'm so passionate about this as an area is because I feel there's a lot of misinformation in the capital raising space. And, you know, not even misinformation, like I suppose we as founders or we involved in this area get made to feel like it's a bit of a dark art, when really, as you get sort of more involved, you realize it's a process. And I really want to today, when I think about sort of the outcome that I really want as we go for this, I really want sort of, you know, you as an attendee to understand that this really is a process. And yes, it's an emotional one. Yes, it involves rejection, but ultimately, the outcome is worth it, you know, especially as we're all working hard day and night to build our businesses. And to give context for me, you know, I've raised capital myself. I've raised from private high net worths. I've raised from an investment bank. I've been through the process, you know, three different times now. And each time I learn more and more. And I'll go through sort of my examples. And, you know, to give the other thing as well is to set the framework for this workshop is that this is not about how amazing I am at raising money. This is more about all the different mistakes I've made and what I've learned in the process. And more than that, it's really about how, you know, things I've observed as well in our clients. You know, we're lucky enough to work with hundreds of companies each year in raising money, and you get to see what works and what doesn't work. And then that's really what I want to highlight as part of this journey as well. You know, for the first 10 years of WI, we really didn't sort of get too much involved in this area. We sort of just took the approach that we'll let the marketplace do what the marketplace does. But now we really want to have an active involvement helping sort of raise the education level of the space. So I hope you enjoy the webinar and look forward to the sort of feedback through it. If you do have questions, please ask or send me a chat message directly and I'll do my best to answer it. And likewise, the people that answered, that asked questions prior to the actual webinar, we'll be doing our best to answer those during as well. So, you know, I hope you all enjoy. So the first one is the outcomes for the session. Really, you know, you guys can obviously read that. The biggest one for me is really just the understanding of emotions. This is an emotional process. Everyone goes through it, but the reality is you get made to feel like you are the only person. And that is just not the case. We all go through this. And, you know, yeah, I'll sort of cover more about that. And avoiding simple mistakes, and where that sort of, what triggered me in going down this whole path of education is that I had one of my clients send a 3-page email with 4 different documents attached to it, to an investor. And now I'd been grooming this investor for the introduction. And pretty much in that one move, you know, I knew that the investor wouldn't want to be interested in meeting, because there's certain ways they like to get information and there's certain red flags for them. And so my goal is to actually avoid the simple mistakes that you don't mean to make, right, out of your keenness and out of your enthusiasm. And then the last part is I want to give you some awareness about CRISP, because I truly believe that the power of what we do, the power of software and the power of analytics in the way it can actually save you time and save you money and actually help you get you to your capital raising outcome faster is just incredibly powerful. And I've experienced it myself. So that's the outcomes for the session. I hope you enjoy, and let's get into it. Okay, so the topics we're going to be covering is the real cost of raising money. Now, the attitude for success or failure, the 7 steps for raising money, the keys to actually improve your conversion rate. I'm going to be going, at the end, I'm going to be going through the investor psychological factors that they experience when they're looking to invest into a company, because you need to understand it from their perspective. We spend a lot of time trying to help investors understand things from our perspective, but we actually need to understand what's happening in their minds. And then the last one is the common mistakes that we see founders make, right? So it said everything. So it should go. Now, the other thing I will say is it will go for longer than an hour. Last time it went for about an hour and 15. So if you have something dead on at 1 o'clock, apologies. We were going 15 minutes over. And then at the end, we typically do a question and answer session as well. Okay, so let's kick off with the capital raising myths. These are the things that me and my team encounter daily. You know, it's interesting for us. The first one that comes in is we have people calling our office. And for some reason, they have this assumption that a capital raising will take 2 to 3 months. I've been doing these workshops. It's sort of hard to do a poll on a webinar, but I've been doing workshops around Australia, Singapore, and the UK. Every time I ask this question, we typically have 100 to 150 people in the audience. When I ask the question, who has been able to complete a capital raising from start to finish, right, within 2 to 3 months, literally one hand will go up, sometimes none, to give you context. Now, for me, this is one of the greatest myths. And unfortunately, what happens is it ends up to being a bit of positioning tool from the investors and also from advisors, in that you start to feel down about your offer. You start to feel down about what you're doing because you haven't been able to complete your capital raising in 2 to 3 months. And it's just not the case at all. In fact, some people take 6, it takes 12, it takes 18 months. Some people are perpetually raising money, right? Because sometimes it's just what it takes to get it across the line, right? So understand that it does not take 2 to 3 months. And if you're so optimistic, and so this is the other part, we have people come in that are overconfident with what they can do, just know that you need to at least plan for it to take 6 months, right, to get done. Next one is that most advisors and companies are using analytics. From our surveys, less than 20% are actually using analytics for the capital raise process, which to me is absolutely insane. It's crazy that in 2020, people are just sending out emails and hoping for the best. They are not tracking what investors are interested in. They're not trying to understand what questions investors are going to ask or anything like that. When you're raising money, the most powerful thing you can have is visibility over what's happening with your information, because then that will help you understand what is the real interest for an investor or what are any potential roadblocks to getting a deal done. And then the last one, which really surprised me, for people that have been in this ecosystem for years, when I talk to them about the high net worth community and what they typically like to invest into, it's amazing how many think that VCs are the main investors. And my retort to that is that, well, it's well documented that VCs will invest in less than 1 in 100 companies they meet. So in fact, one I've chatted with was 1 in 818. Out of 818 deals, they invest into one. And the largest one was actually a Singaporean one. It was 1 in 1,000, right? So if VCs aren't investing into these deals, how are these companies being funded, right? And from what we've observed, it's between the high net worths, it's between the ecosystem, right? The operators within the ecosystem, and also between the family offices. Right, so these deals are getting funded. So this presentation is about how you can get access to that capital. Now, the important thing to understand, sorry, I just had a quick drink. Your throat gets dry very quickly. When you're going through the founder psychological process, you got to understand that when we go through it, we'll start preparing our material and we build ourselves up. We excite ourselves, we talk about our plans, we spend a lot of time, we've been bouncing around ideas, and we think we're on to the next big thing, right? And in our minds, we think we've got the most beautiful baby that they go, because our businesses are our baby, right? It doesn't matter how many people tell us how ugly it is. In our mind, it's the most beautiful thing they're ever going to see, right? So the first way that we always start out with a capital raising is typically as founders, we start out with overconfidence, right? And that is 100% normal. And the only thing that changes that is you go out, you start doing a few presentations, and all of a sudden you start getting rejection. When you start to experience that rejection, you start to, basically have some doubt creep into your mind. Now, it could be 5 rejections, it could be 10, whatever it may be. At some stage, you will have some doubt creep into your mind, right? Understand that this is 100% normal. You could be feeling down that day, you could have not slept well the night before, you could have had you could have received bad news, but all of a sudden you've got doubt coming into your mind about what you're doing. And then typically when people start to have doubt, right, and they continue getting rejection and they keep on sort of questioning themselves and so forth, it tends to lead to the next one, which is fear, right? And typically those two work hand in hand. And what I've seen with people is, as I said, they're going through this process, they're still continuing to burn money, right? Still investing into the business, but still urgently, some getting closer and closer to really urgently needing the money, right? The fear creeps in and they start to wonder what have they done and all that sort of stuff. Then all of a sudden, an investor decides to say, yep, I'm going to be participating, I'm going to be putting such and such money in, blah, blah, blah. And then all of a sudden, you're back to being bulletproof again. And the most beautiful thing for us as founders is this psychological process can all take place in one day. make no mistake, is an absolute roller coaster ride of emotion, right? Sometimes all those feelings can be done within a few hours, right? So it's just really important understanding that that is first up what you're about to experience. Now, the next part is rejection. Now, I do something in this workshop that no one else really does. I actually give you how people have rejected me. Now, the reason I do that is because I want you to understand that we're all hearing the same stuff. We're all hearing the same rejections, right? It is 100% normal. The first one that most people are likely to hear is that your valuation is too high, right? That is, I said, it's just really rare, so when you're dealing with larger investment groups, it's really rare where they start off from a negotiating point and go, wow, that valuation's really reasonable, right? I'd love to hear that. And of course, as founders, we're always trying to push the boundary as well. The next one, which is probably the hardest one for founders to wear, and one of the ones that I think founders get the most upset about when dealing with high net worth investors, is that investors are super polite. So they don't want to reject you because they may be interested down the track, but what they do is they stop replying to you. You'll notice that someone will be interested, they'll tell you that they're keen for a certain parcel, and then all of a sudden, silence. No replying to emails, no activity in your deal room, and you're just wondering, what on earth happened? You've sent 3 emails, you've tried text messaging, you tried calling, and just nothing. And you're at the point, well, am I stalking here? Right? When they don't reply to you, that just means they're not interested. Right? All these other ones don't prefer to go in at Series A, the time frame is too short. For me, this was a personal one that I received. You're too much like equity crowdfunding. Now, the hard part for me is I couldn't retort this, right? Because it was with an investor in the UK. And if anyone knows me, I've spent years making sure that we are not positioned in equity crowdfunding area. So sometimes you just can't change the minds of people, right? No matter how passionate you are. This one's always nice to hear. For me, when I heard this one, that I've decided to invest into another company, I just thought to myself, imagine if you're on a dating application and the guy that you're talking with turns around and says, look, thanks for the interest, but I've decided to go with someone else. It's bruising for the ego, but you will get it, right? Next one, this one's a frustrating one. Here is the business I'm involved in. So for me, this was after spending a significant amount of time with someone. They then decide to turn around and show me a business that they've already invested in and weren't looking to invest into me. It's like, okay, why did I just waste my time? Now, this one's always heartbreaking, right? When you get the same rejection that someone gets for not buying a vacuum cleaner that you get for your company offer for raising money, which is my wife is not keen on the investment. And someone may want to highlight that it could be the other way around there where they say, my husband is not keen on the investment. Either way, it still doesn't feel nice that someone that you haven't spoken to, haven't communicated with, is deciding that they're not interested, right? All this sort of stuff, all these different reasons, all they are is different rejections. And you've got to understand it is what it is, right? And the last one, we don't like gingers. Now that's obviously a joke, but it's sort of just getting you prepared that you will receive a lot of rejection along the way. And I could add plenty more to this, but these are the most common ones that I heard from me going through the actual capital raising process. Now, every day with Wholesale Investor, I have investors that will say to me when I'm having conversation, they'll say, all right, Steve, what I want you to do is I want you to introduce me to the good deals. Now, this is bizarre for me because if anyone could tell me what is a good deal and what is not, that would be absolutely amazing. The reason a marketplace works is because everyone has their perspective of what a good deal is and what a good deal isn't. For the 9 people that reject me, that think my deal isn't a good deal, for the 1 person that accepts me, for the 1 out of 10, fantastic. They think I'm a good deal. This is all about a marketplace, right? What is good and what is not is very difficult to understand for every single person because they have their own version of it. Now, on the flip side, every company that we come across with Wholesale Investor and Crisp says to us, Steve, introduce me to the good investors. That's fantastic. Again, show me what good investors look like, right? The best thing I can say is that when people, like, if I'm going to do that, that's fantastic. But how do I know they're going to be interested in you? How do I know they're going to be interested in your sector, right? And so this is what is so strange about this space is that people think you can just simply cherry pick. It's a marketplace. People want to stick their hand up as to whether they're interested. I just believe the job of us as founders is to make ourselves as visible as possible to generate that interest. Okay. Now, I'm going to use this story because I think it's just such a beautiful example of what you need to do to actually raise money. Now, obviously going against that, what I talked about is that it only takes 3 months to raise money. Look at this. Blackbird, when they went to raise their fund, right? I believe they started raising in 2010, right? Even though it's called the Blackbird Ventures 2012 LP, right? It took until 2013 to close. Look at that. They had 500 meetings in 22 months to raise $29 million from 97 investors. Now, if you break that down, right, that means that they had a 1 in 5 conversion ratio, right? Because almost 100 investors from 500 meetings, right? And the 22 months to raise 29 million, that means their average investor size was $300,000. Now, what is really important about this is they were already successful before they went to raise this money. So these guys were leaders in the Australian ecosystem before they went to raise, and look how much effort they needed to go to raise money. So if you think it's going to be lay down easy to raise money, absolutely mistaken. And often this is what we deal with, right? But look at that, 22 months, right? And 500 meetings to get that done. Now, the next one's a beautiful story as well, because if you look at Catcher, right, when you look at the story for them, you know, at that stage, Catcher also owned iProperty Group. Now, iProperty Group was worth over $500 million at this stage. It was already a success story. Now, before they raised any money for that, they were rejected 74 times. Right, then what he did, so he's already been successful with iProperty. He's also listed iCar. This is Patrick Grove, by the way. So he's a famous entrepreneur, very well respected, right, for his ability to build companies. And all he did was take successful models in Western worlds, in the US or in Australia, and overlay that to Asia, right? So what was interesting about it was when he did iFlex, he got rejected 115 times before they successfully raised their first round of funding. This was after he'd already built a business over $500 million. Okay, so just to give you context as far as what is possible for them. Sorry, what is possible, but how much effort they needed to go to. So when I ask this question, what is capital raising? And it sounds pretty obvious, right? With people say, well, it's raising money for your business, right? But really what capital raising is, it's a sales and marketing process, right? And when I say that, the marketing part is obviously to attract potential investors, and then the sales process is what you do to convert them into a shareholder of your business. Now, if you think about that, it starts to change your perspective, right? Because it starts to get you thinking about it slightly differently. I don't want you to leave this webinar feeling like capital raising is some sort of mysterious dark art, because it's not. It is simply a process that you need to go through. And in this webinar, there's some framework to work with. Now, what is the actual equivalent? Now, if you think about this, if you're going to hire a new business development person, right? And if you think about hiring that new business development person, what would it be like if you actually just, day one, brought them into the office, showed them around the office and said, look, there's your desk. Here's a brochure, right? In our world, we know that as a pitch deck. Here's your brochure. I want you to go and sell. You're not going to give them any systems, right? You're not going to give them access to any scripts, no CRM, no software, right? No clearly defined pathway to success, right? And I said no scripts, right? Give no analytics whatsoever, and no understanding of what they need to do or benchmarks that they need to work towards. How do you think they would go in that new role? Just think about that. The reason why I use this as the equivalent, because this is what most of us are facing. Most of us have got pitch deck in hand or IM in hand, and we're out in the marketplace trying to raise money, but no one's actually really provided us with the right software, processes, systems, scripts, CRM, and pathway to success, right? And that's what I want to help you understand, that if you don't feel like you're achieving your capital raising goals, and it's because you don't really, no one's really said, people aren't voluntarily giving out the tools to help you to do this. And if you think that just the pitch deck is enough, it isn't, especially when you're competing. If you want to understand your competition is the 15 to 30 other companies that are going to be pitching that investor for money that month. Not that year, that month. That's how many deals these investors see, right? So just want to highlight that. You want to give yourself every chance of success as possible going through this process. Now, I highlight this example as the problem we didn't know we had. So I like to use the example of Blockbuster. Now, the reason I use the example of Blockbuster is because whenever I mention it, now obviously we're on a webinar and I can't see, but whenever I mention Blockbuster, people typically have a slight smile on their face, right? Because people have good memories of Blockbuster. They've got a good memory of going there on a Friday and Saturday night, right? They're walking around. Some people will have, for those people that didn't bring back their videos on time, they'll have memories of paying video fines, right? But you have memories of going there on a Friday and Saturday night, right? And it was a good experience, typically a family experience, right? But what happened to Blockbuster? They went from 85,000 staff in 2004 at their peak to bankrupt, right? And the reason is, and it's the exact same thing with taxis, right? Taxis obviously haven't got bankrupt, but they've had massive disruption via Uber, right? Markets will move towards solutions which save them time, money, and improve efficiency. Now, the reason I highlight that is because if you cannot make that experience for your investor, where they can have an efficient process in dealing with you, think of them as having ADHD, attention deficit disorder, right? They will move on to something else. Think about that. People and markets move towards efficiency, right? So you have to make your process for raising money as efficient as possible in the construct that they like to receive their information, right? This is what's so powerful about this process. So now what I want to do is I want to delve into the real cost of raising money, because there's a few factors that most people don't think about in this area. And as I said, if people want to ask questions whilst I'm talking, feel free to ask it in the chat and I'll do my best to actually answer it whilst we're going through. So the first one is roughly about 20K, right? Most people know these fees. Typically, depending on your professional service, this will not include typically your corporate advisory services if you're going to use a corporate advisor. I find now that probably about 70–80% of our clients don't use corporate advisors. They typically either have someone on their board that will do the raise themselves, or they're actually doing it themselves. But you know, typically that's the fees between accounting, between legal, and between the document creation. You can expect to pay about that amount, right? The part that which people don't think about is what is your actual time worth. So I've used this sort of analogy that if you're looking to create $2 million value to your business in the next 12 months, your time is worth $640 an hour. Now that's on the assumption that you would work a 60-hour week. The reason I highlight that because the cost of your time in the capital raising is one of the most valuable assets, but we don't think about it because we just wear it and we know that has to be done, right? The other part which people don't really think about, right, is the cost in actually preparing the documentation to do it. So even though you can have people actually help create your documentation, you still have to get a lot of the information ready. Right? So, you know, at a minimum already, you said you're dealing with, you know, at least 16,000, 20,000 up front. But then the other one is the actual time that you will speak with investors. So if you were to break this down, if you're going to speak to 50 investors in the next 12 months, and this is how I want you thinking about it, because you're going to do this anyhow. So the question is how do you make this the most efficient? If you were to speak to 50 investors over the next 12 months, is likely that you will spend an average of 90 minutes. Some you'll spend less, some you'll spend more. But on average, about 90 minutes seems to be the average. So this will be 2 to 4 weeks of your business time taken up in the capital raising process. When I put it in this context, people are not often thinking about it. But I need you to fully understand it because I need you to have the motivation, right? Where we're looking at ways for actually improving that efficiency. Now, the next part is how do you, is the actual opportunity cost. For me, when I went through the process, right, when I reflected on it and went back through the sort of revenue during that period, it was me and I had to actually have another team member assist me. I realized that the two of us involved actually impacted a revenue by 80K. So most people aren't thinking about the revenue cost, right? Or the opportunity cost, or the revenue impact and the opportunity cost when they're actually raising money. In fact, to the point that, when we did the deal with Investec, I was so impacted by that deal about the amount of time that I was spending between dealing with advisors, lawyers, professional services, board members, and also with Investec, that we actually experienced a revenue decline in that 12-month period. So my first meeting with them was actually letting them know that our revenue had dropped. What surprised me most was when I mentioned that, the comment back from them was, was that because of us? So what I realized at that point was that this was common. VCs know it, investment groups know it. In fact, they expect it, right? So what my goal is how do you reduce that as much as possible? All right, so in total already, this is before we actually include any success fees, right? On a standard raise, your total cost, if you include all the intangible factors like I mentioned, is 134K, right? So that's just the starting point. Now, when I get to later on in this presentation, I'll actually highlight some other areas which you're being massively impacted, which you're actually not thinking about. All right, but what is the actual business cost? Now, we all know this. We always think, okay, well, you know, for me, the best way I can describe it is inefficiency is incredibly expensive when raising money, right? Because if we don't get the process right, these are all the different ways we get impacted, right? And we all know this. A lot of us would have actually experienced it in our journey, and a lot of us would, you know, may even be experiencing it now, right? And then the actual personal cost, which is the part no one talks about because we're just expected to wear it, is I'm sure all of us know someone that has experienced a loss of either of these. Be it relationships, sleep is one of the biggest loss for most of us as founders. Funniest thing is I showed a group of executives this presentation. They said, yeah, well, most of us experience that on just normal business. When you're raising money, all these emotions are just elevated, right? Because obviously there's an outcome of the business requiring capital to continue. Now I put this up here. The Dunning-Kruger effect is an important one because it relates to your attitude and your likely success or failure with an attitude. Now, I'm sure people are worried, oh, I just want to know how to get access to investors, Steve. All this is super important, right? Because it really gets the psychology right as far as where your head needs to be when you're actually going through the process, right? Now that you've had a read of that, this is what it looks like actually on a graph. This is what we deal with every day. In fact, literally had a conversation with someone about this yesterday on the public holiday. Yesterday, I had this conversation with someone who hasn't raised money before, which actually said, well, you know, I've spoken with investors before. I think it's going to be fairly easy for me. Maybe I'm just an optimist. We're all optimists. Otherwise, we wouldn't be founders. You think pessimists run businesses? Absolutely not. We are in our DNA optimists. But do understand that the little knowledge we have, the more confidence we're going to have for no reason whatsoever. This is the journey that you will go through. And depending on how many capital raisings you've gone through, where we want to get you to is to this area where you feel like you know nothing, right? And the reason for that is because the only way that you can become an expert or you can really increase your competency in this area is through practice and through actually just doing deals and through raising money. And that is always a forever discovery process, right? But the important thing is you got to still keep thinking about it as it's a process and it's a numbers game. Now, when people think about raising money, when they're actually starting out, their expectation of what a capital raising looks like is this. By the time they get, as they go through their capital raising, the reality is more like this. Right? And sometimes you actually do feel like that. Said it's just part of the journey. So success attitude. Now these things are all pretty obvious and pretty basic, right? And yes, they're just words on a paper, but really the best thing I can say is that when we've worked with founders, right? Because we're obviously from a wholesale investor perspective, we'll work with 300 plus companies a year. And when you look at the companies that typically raise or do the best at our investor events or raise the most money, they're typically the most proactive people at the event. They're also very optimistic. They're also opportunistic. So they're actually going out of their way to introduce themselves to people. They're creating they're going out to, they're sort of making the most of all of their experiences, not sitting back and waiting for people to just come and chat to them, right? That is their typical nature. And then also the other interesting thing I found is they go in with the attitude, they're just looking for one good contact. And it's funny because I always try and let people know that I always feel this space that one person can change the trajectory of your business. You just don't know which one. You have to speak to 100 people to get to that right one. And it's really about having that persistence and the consistency of actually doing that. So our core principles, and we designed these for Chris, but obviously it makes sense for anyone that's actually raising money. The first core principle is to get ready. And the reason I say is because when Investec came interested in Wholesale Investor, I wasn't ready. And in fact, it took me some time to get everything in order, to basically have the material ready for what they were after. And that is time consuming, because every bit of you that's not ready is going to eat into that opportunity cost or that revenue impact that I was actually talking about. So the first step is to get ready well before you actually see me start to raise money, right? And get ready means get your deal room in order, get your data room, get your due diligence information in order. And there's plenty of different stuff online that can show you what to put in a DD pack. For our clients, we're now supplying that as a bit of a template as far as things that they should be looking to get ready in their DD. Stay ready is another important point. Now, the staying ready part is just effectively updating your results quarterly, right? This is so much easier than waiting till you have an interested investor and then trying to cram everything in, doing the old university trick where you just cram everything at the last minute, right? The next step is always be raising. Now, this step typically surprises people because they always thought about a capital raising as, well, I'll do this once every 12 months or once every 2 years. The reason I say always be raising is because when you're a business owner, we often don't know what opportunities may come our way, and we also don't know what disasters may come our way. It's also the importance of that diligence in that skill of consistently be talking to investors about the mission, refining the vision and so forth, because at different stages, sentiment may change. But it's important for you to be on top of that as you're going through the cap raising process and as you're just going through the general business building process. In fact, for me, I've learned a lot from my investor discussions. And then get to a yes or no as fast as possible. Do you know how many times I've heard it? We often deal with founders where they're so frustrated because they've spent 6 months with an investor to hear them say no, right? And it's because often they didn't have their information in order to get to that no, right? What you don't want is, instead, we actually had one client where they got requested information from an investor who's actually become a friend of mine. They didn't reply with those requests for information for 4 months. That deal is dead, long dead, right? Investors expect fast replies to questions that they have. And if you're going back and forth on a daily, it just really slows down the momentum of a deal. One of the best principles that I learned was there's 2 things that can kill deals. One is time, the other one is lawyers. Now, I love lawyers for different reasons, but in the deal sense, I'll explain later what that actually means. So when people are thinking about high net worth investors, they often have this vision of someone walking up to them and then offering them $500,000 and then, just staying silent in the company and then not adding value and so forth. That's what they have this vision of. They have someone that's got so much money, they're just going to throw it at them and just let them crack on with, building their business. This is not the reality, right? So in this information, you can see the types of investors, you can see the breakdown of our database. You can also see where our database is actually located. That provides you with a bit of a reference. And at the top, you can actually see what sectors are of strong interest to our subscriber base, right? So, the top areas there you'll see, and this is basically what's going to feature mostly, these companies at the top as well will feature mostly at emergence. What is most interesting for you is we've broken up these graphs as far as the typical first investment from an investor and also the investment after that initial investment, their investment capacity, right? Now that is really important because what you'll notice is that 78% of investors look to invest between 0 to 250K for a first investment, right? So your visions so if you want 500K or above, you're literally knocking out 89% of people that could potentially invest into your company. So that's why when we deal with businesses, we recommend that they put their minimum subscription amount at somewhere between the 50K amount, or if people are looking at raising a little bit less, maybe they can put it down. If they're an earlier stage company, they can put it down to 25K, right? But it just gives you a number to say that that if you're going to do it at let's say $500,000, you are knocking out 89% of potential investors. Right, so investors, when you're dealing with private investors, they typically have an amount they like to invest. When you're dealing with larger investors, they typically like percentages of the company. But what's really important to note is that if you look at the follow-on investment, the capacity after the initial investment, 14% are looking to put anywhere between 1 to 5 million into the business, right? So it suddenly jumps from 4% to 14%. That is so powerful for you to know. And at 5 million, it goes from 1 million, it goes from 1% to 5%, right? Really, really interesting for you to know and for you to observe going into a capital raise, okay? This is one of my new favorite sayings. I actually come up with this. I'm actually quite proud of it. But I think it's because I was really trying to help people understand that tire kickers are actually investors, right? They're a tire kicker to you. But the best way I can describe this is one person's tire kicker is another person's shareholder. And it's humbling for you to realize, because sometimes we say it in our own heads to keep our egos nice and inflated. You know, when someone basically rejects us or goes quiet, we think, oh yeah, that person is just a tire kicker. You just got to know the reality that that person is a shareholder in another company, right? They'll be probably shareholders in multiple companies. They're just not going to be a shareholder in you. Okay, so let's go through the 7 steps. Okay, so the first one is a setup and frequently asked questions. Now the setup I'll show you in a second. The frequently asked questions is one of the most powerful things that I've added to my process, right? And I'll show you exactly what mine looks like and how you can sort of set up your own. But I effectively have set up 3 rooms, right? And I'll go through in a second. Step 2 is inviting investors, right? And I'll give you the outline of who to invite. Step 3 is how you can actually discover and how you can attract investors to your business, how you can actually manufacture serendipity. And I love that because that's effectively what you're doing. Next one is discussions and presentations, right? Now I sort of give that as a bit of a high level, but I'll go into a bit more detail. One of the biggest frustrations for investors, just so you know, is that if you say, for example, book a 30-minute meeting, but you talk to them for nonstop for 2 hours, that is not a good sign. The more an investor is engaged with your business, the more questions they will ask you, right? So here's the different rooms. These are different rooms that I've set up. I've got a DD room, I've got a financials room, and I've got my main pitch deck room, right? Typically the DD room is more for professional investment groups that are looking to put a larger amount, right? But I find that the pitch deck room is enough, right? And I find that 90% of potential investors are happy just to look at this room. And you can see the example, I've got the information set up in my DD room. And obviously I'm using CRISP. CRISP stands for Capital Raising Intelligent Investment Secondary Platform. Now the reason I use it is because I can have analytics when they actually do go through the DD process. This is my pitch deck room. As you can see, I've just got a pitch deck in there. I've got an investment flyer, which has an overview of the investment. I also have some traction. I showed the traction of CRISP to date as an example, and just some basic other information, and obviously my pitch deck as well. Now, the frequently asked question process, if you look at this, what the goal of this is that when you go through a capital raising, you typically answer the exact same questions over and over again. In fact, your day is spending hours and hours of answering the exact same questions. So what we did is we implemented this this FAQ management system, right? So that you could do 2 things. One, at the end of each day of answering questions, you could put in the most common ones which you get asked, and then you could put in a standardized answer to those questions, right? That way, for future investors, they can see those questions and you don't have to answer it again. Secondly, you can see the numbers down the side. I'll explain them in a second. But my goal in doing this is I want to get visibility over what's happening in my deal room. And also I want to save myself a bucket load of time in the actual capital raising process. So for me, this has been the value that this has provided to me is, you know, it's hard to even describe, right? I've raised a significant amount of money on CRISP already. I said I was the first deal on the platform, but using that FAQ is super powerful because I said it helps you. Please list the steps on the previous. So the attendee just asked about the steps on the previous slide. I'm actually going to go through them one by one. Sorry, I'm just going to close this down. Okay, but that was the different steps. Set up FAQ, invite investors, discover and attract investors, and discussion and presentation. Okay, now here's an example invitation. Now the reason we actually create these templates for our clients because we realized that sometimes, you know, companies would send out these really long emails to investors and investors just wouldn't open them. In fact, one of them I saw was not the 3-page email one, but I saw another one. They sent an 80-page document as a starting point. No investor is going to read a document that's 80 pages long before they know they're interested in you, right? So I realized for me that not only could I have input in the education side, but I could have input in the process side. But you can see this type of email. It's really simple. It's to the point, right? But more importantly, it doesn't bombard them with information. It's bullet point driven and it's step by step, right? But also what it's saying is that once you actually set up a time to have a conversation, then you'll be providing access to the deal room. Now, the discovering and attracting investors, I won't go, obviously you guys can read, right? But the most important one I want to highlight, this stuff people know, but I really recommend proactively setting up a registration of interest list and communicating them. In fact, for most people, you can get most value from this webinar if you do two things, right? One, do your best to attract 50 investors to your deal room, and two, communicate with them 4 times a year. But when you're looking at this, one of these ones that you'll be looking at thinking, geez, would that really work? Is suppliers and customers. Can you really raise money from suppliers and customers? In my case, I've actually got both a supplier and a customer as a shareholder, right? Because sometimes they're strategically relevant to what you're doing. The rest are fairly standard, but number 5, as far as the external promotion of services and conferences, right? The job, you've got to make yourself as visible as possible. That is your job. You've got to move from being unknown to known, right? All marketing is about moving from unknown to known. It's about making that connection. So the more people see you in the different places, the more they can actually start to identify you. Some of the easiest companies that we get the opportunity to work with are ones that have already got media profiles, right? Because they've been covered, or they've been active in speaking at their different industry events, or they've just been active in getting their own name out there, right? But we highly recommend you do this 6 months before you go into your capital raise. Now, how can you actually, where can you do discussions or presentations? Meetups is one way to do it, right? Pitch competitions is another way, right? And I always recommend these because it's always about practicing and refining your pitch. Media articles I've found have been really powerful because sometimes it's not about who reads that article that day. Sometimes it's about people that get the opportunity to read your article. It could be 6 months from now, it could be 12 months from now, right? But either way, they can track your interest and they can track your progress of your offer, right? Now, the final steps in the 7 steps process is the activity tracking. So this is how I use it for my frequently asked questions, right? So you see the number on the side. That number on the side represents how many people actually clicked on that question, right? So so basically you guys know that when you're actually looking at this, you know what are the most important questions to investors that are actually looking at my offer, right? Because for me, this is one of the most powerful bits of data that I have. Because what's really interesting is when you actually scroll to the bottom of my FAQs, those questions that are sitting on the bottom, I actually thought were going to be the most important, and they're not even there. They're not even close to being at the top. What is actually at the top is things related to valuation and actually things related to the business model and to scaling, right? That is interesting for me. Then and this is said, I actually don't know how people raise money without having these sort of analytics, right? This is my leaderboard inside this is my real deal room. This is my leaderboard inside of it. So every activity within the platform gets a score, right? And then that score helps me understand who is the most interested investor in my business, right? It's amazing how accurate this is. And where we want to get to with the data part is that when the platform knows a successful transaction is going to take place before it actually takes place. Now, this is an example of an investor that went into my deal room and actually became a shareholder. Here is what they did before our discussion, right? Just think how powerful this is for you to know what an investor is interested in before you even have a conversation with them, right? This is the data that I was able to get access to, right, prior to. Now, what's so important about that is that otherwise, I realized now 12 months ago when I was having chats with people about WI and our capital raise, I was actually going in blind. Now I go in with confidence because I know exactly what the conversation is going to be about. I know typically what we're covering. And also I know that if someone looks at my docs and frequently asked questions prior to the conversation will typically be 30 minutes, less than 30 minutes, somewhere between 7 to 30. That is powerful for me to know because it can save me a lot of time in the actual process and also adds to professionalism. So when you're creating webinar, when you're going through the launch phase, there's a bunch of things you need to do, but you need to look to open your capital raise for 60 days. And in that time, you need to be doing one-on-one meetings, you need to be doing a webinar, you could be doing boardroom sessions, and also you need to be involving yourself in conferences, right? Because that is how you need to be exposing yourself to hundreds, even potentially thousands of people that could be relevant to you, right? It's not doing it in a cheap way. It's just making yourself visible, right? It's about manufacturing that serendipity. And then when you're creating your progress updates, you can typically do that via email and you can do that via webinar. I highly recommend communicating at least 4 times a year. Now, here's an example of some of the communications within CRISP. You can get the idea of how, how simplistic I sort of talk to people and how I don't try and bombard them with information, right? On the last one, right, you can see that firstly I asked the question if they're a private investor or if they're an investment group. Down the bottom, you can actually see that what I'm doing is I'm actually saying, look, I'd love to organize a brief introductory phone call with you to discuss the opportunity. Let me know a time which suits. Once we lock that down, said, let me know a time which suits, and I will provide access to the data room where you can review further information. Now, what's so important about that is I want to schedule a time before I provide access to the deal room so that I know we're at least going to have a conversation. Now, these steps are simple, but if you don't have this framework and if you don't follow this process, right, you could be sending out information and you'll be sending it out to crickets. And there won't be any follow-up discussion, and you'll just be wondering why is that investor not coming back to me? Right? I said, this is a marketing and sales process, right? So you keep things simple and you make sure you give something to get something. Okay, as I mentioned before, communicate with investors typically anywhere between 4 to 12 times a year. That is important, right? And so you've got to know your numbers. You've got to get, in looking at that, you've got to get at least 10 to 40 investors into your deal room before you can get one investor. Right. This is so important because most people think that you just send out and when I say the reason why I say into your deal room is because they've actually taken an action to get more information from you, right? That's a really important step and a really important point. Okay, now this one, now is going to slightly switch gear. I want you to help you understand your own numbers behind your capital raise, right? Now I'm going to use an example situation. But I asked you in the email before today, I wanted you to actually have a think about this, right? I wanted you to think about how many investors will you speak to in 1 year? Because you're going to be doing these activities anyway. If you spoke to 50 investors last year, you're likely to speak to 50 investors this year. If you raised $1 million last year, then you think, well, if I spoke to 50 investors and I raised $1 million, how many do I need to speak to raise 2 million, right? How many will you convert? That's important to know. What is your actual average conversion rate? Right, like one of our clients, they've spoken with 2,000 investors and converted 200. They've got a 1 in 10 conversion ratio. So following the process, and whether it's the most optimized or not, that's another discussion. But following the process, they should know that every 10 investors they speak to, they will at least convert 1. Right? What do they typically invest? How much they typically invest? Is it 50,000, 100,000, 300,000, 500,000? What is it in your case? What is your current conversion rate? So that's important to know. What is your investor acquisition cost? And how would you score your process on a scale of 1 to 10? Right? So if you were to say that 1 being that, your process is inefficient, horrible, you lack confidence, you don't really know what you're doing, that would be a 1. 10 being, I am the best capital raising person on this planet. That is a 10. So where would you actually rate yourself? Right? That's an important part because it's good for you to know where you actually think you're at. And that first number that came to your head, right? Go with that one for this discussion. Okay, so how do you actually improve? Well, the first part is if you could increase your conversion rate by 50%, how much more would you have raised? If you reduce your professional services by 75%, this is what I want you thinking about. I want you thinking about if you just improve these efficiencies, the difference it can make. Because as I said, the biggest frustration I have is everyone's like, oh, I just need to speak to more investors. Well, if you spoke to 100 investors last year, maybe you just need to improve your efficiency, improve your conversion rate. right? Maybe you just need to spend less time. Maybe you need to improve your process so you can actually spend less time with investors. I want you thinking about this slightly different because you're going to do the work anyway because you're going to be raising money. So why not do it in the most efficient possible way and that allows you to raise the most money and spend the least amount of time on it? Okay, so let's go through this. Let's say you've got a situation where the average investor will contribute 100K, right? Now, your current conversion rate is 10%, right? And this is, just so you know, if I speak to one of our clients and they tell me that they've got, and I can see that they've got 40 investors, right, that are looking at their business. If they haven't converted one, I know there's an issue with their process, right? Just so you know, that's how I look at things now. I look at it from a process point of view. Okay, current conversion rate, 10%. Next one. So if you're going to speak to 100 investors over the next 12 months, your likelihood chance is you're going to raise 100K from 10 investors. So that means you're likely going to raise $1 million, right? Just on average. Now I've got to keep this round numbers to keep it really simple. Now the next step is, if you could reduce your professional, now this is exactly my case, right? So if you understood the process, so you didn't require didn't require exorbitant amount of legal and accounting work done in the lead up to it, and you could reduce that, you're literally saving yourself $15,000 to start with. And this is not hard to do at a starting point if you've got the right process. Next, if you can reduce your time spent with investors, my average time spent with investors is now at 45 minutes, right? Some is less, some is more. It just really depends. But for me, what that represents is actually, a $14,500 saving, right? Now that's important for me because what is the biggest cost for me is actually the opportunity cost, right? And the revenue created. So rather than me losing out on revenue, I can still generate. In fact, last time I did a capital raise was sort of around October, November. We actually had one of our biggest months in that period whilst actually raising money because I'd actually refined my process and simplified it, right? So that is really a really important part. You don't want to be losing massive amounts of money on opportunity costs or having revenue impact whilst raising money because effectively you're impacting the capital that you're actually raising. Now, this is the biggest one. This is the one that most people aren't thinking about, right? But if you could actually, let's say you increase your conversion rate by 50%, right? So when you speak to those 100 investors, let's say you convert 15 investors. Now, just to give you context for this, I went from a 1 in 11 conversion rate to a 1 in 4 conversion rate, right? That was the difference in mine. I was very close to 1 in 3, but I went from a 1 in 11 to 1 in 4, right? Now, the difference is that if you do in this sample given, you would have raised $1.5 million. Now, the difference for that means that effectively your total increase is 500K, but more importantly, in total, you've either created an additional 500K, right? Or you've saved, right, 54,000. This is the impact. This is the opportunity cost or opportunity lost on not having efficiency. So whilst everyone's talking to me about trying to get access to more investors, I'm just sitting there thinking about how I can provide the information, the processes, and the software to actually improve that conversion rate, right? And that conversion rate, not because you're saying it, not because you're trying to get investors too excited or anything, it's just because you are giving them the information they are looking for to help make a decision as fast as possible. Trust me, investors are just as frustrated with how long it takes for capital raising. They get most annoyed about how long it takes them to get information. They get most annoyed about the time that people take, in helping them sort of explain their opportunity. They get most annoyed if they can't get what they want straight away. Exactly like I use the example for Netflix and Blockbuster. In this case, if you're not giving them what they want straight away, you're Blockbuster. The deal that's giving them the information they want straight away, they're Netflix. Think about it like that. It will really start to change your perspective, right? This is the biggest value that you have. It will save you you get the process right, it will save you 6 months of raising capital, right? The other part that I say to people as well is that what you want to do is you want to get as much momentum is one of the hardest things to create in a capital raise, right? So, as a final question, I was like, do you just need to speak to the good investors? Yes, you always need to be speaking to good investors, but you need to be also constantly refining and improving your process, right? And not just doing it for your benefit. In fact, doing it for your benefit actually benefits your investors. All right, you are saving them time and you are making their life easier. The easier you make it for them to invest into you, the easier it's going to be for your capital raise going forward. Okay, so what is the psychological process that the investor goes through? Well, the first one is step one. Now, I'm speeding up because it's sort of already becoming 5:2. So we are coming close to the end. So if you do have any questions as we're going through, please send me a direct message and I'll do my best to answer them. Send me either a chat or through the Q&A. Loss aversion is typically the first one. Now, when investor, most people think about loss aversion as in just losing money. That's only one of the factors. They're worried about losing time. They're worried about losing credibility. But what is their actual biggest loss, right? Opportunity cost. That money that they've invested in with you, they could have actually invested with someone else and received, that could have been the afterpay that they missed out on, for example. That's how they think. Right? Don't want to be the first one in and don't want to miss out. For most of you, you would have had the situation where an investor says to you, who else has already invested into the opportunity? We see this quite common in the capital raising especially in media, when you see about media notifying about capital raisings being done, they'll always mention the lead investor and then they'll mention the follow investors, right? Investors don't want to be the first ones in, but they don't want to miss out. Because once they move beyond that being the first one in, then you move into the bandwagon effect. So for example, if Airtree goes into a deal, there's often different investment groups that like to follow on Airtree in specific sectors or in specific areas, right? In fact, there's more follow investors than there is actually lead investors. But the bandwagon effect plays a very common role in the capital raising process. And then the stage that you really want to get to is FOMO. So you want to get to the stage, you do your best to not start raising money until you've got at least 50% of the capital raised, right? To officially launch the offer. So you do your prep work, your building of interest, you're building your names and so forth. And then the next step is that, you want to try and get to that stage where they've got fear of missing out. And you often see this with IPOs or larger deals that sort of people are really quite enthusiastic about. When an investor is looking at your opportunity, now the reason I highlight this is the biggest area I don't give advice on is valuation, right? Because it's such a gray area, right? And that is definitely an art to that valuation area, right? And all I really want to highlight is that when investors are looking at your business, they are mentally going through their head how they can either receive a 5 to 10x uplift, a 5 to 10x return on your business. Some will say it to you directly, others are just thinking it. They are trying to know how you are going to 5 and 10x their money over the next 3 to 7 years, right? That's what they're trying to figure out. The other case they're trying to think of is if you're in pre-IPO mode. So when we do our surveys, one of the most interesting deals which gets the most interest is pre-IPO opportunities. And that is because there's an impending uplift, because typically when you go from pre-IPO to IPO, there's typically a 20 to 30% increase in the share price, right? And there's a potential exit, right? So because you're going to list on the ASX or whatever exchange it is, there's a potential for you to actually sell your shares, right? So the impending uplift or exit is what they're actually looking for. So these are the psychological factors that investors go through in a capital raise. So what are the common mistakes? First one, I've highlighted this a lot. Do not be unrealistic. Going in overconfident and unrealistic is going to be your downfall, right? Because you'll be humbled very, very quickly and you'll just go through that psychological emotions. So the emotions I talked about at the start. Right, you need to be willing to invest into the process. If you're not going to be investing your money and time into this process, I said, it's just going to be really hard. It's like literally walking up it's like hiring a marketing manager and saying, go and generate me leads. And then them turning around and saying, okay, well, what budget and what time, what resources do I have for it? And you say, none. And like, okay, so what am I actually working with? Right? You got to think about, you are selling your business, you are marketing your business, right? It's your baby and you're a lot more passionate about it. You need to invest into the process and understand it will take time and it will take money, right? Reliance on one existing investor. I've seen this happen time and time again, where founders rely on one investor and often they don't come through for future rounds. This is the one that hurts the most, right? Where I see companies where they're relying on one potential investor and they don't have any time pressure around the deal, right? I said, and just so you know, I've made all these mistakes myself. Like, this is not like, I'm excluding myself from making these mistakes. In fact, this one was exactly my situation, right? The reliance on one potential investor with no time pressure. It means they can dictate the terms because there's no one else at the table. Having pressure in a deal will help you. And that's why I said, create as much as visibility as possible, because what you want to do is you want to create interest and momentum, and then get to a stage where you've got the ability to create that time pressure in the opportunity. And the final lesson that I've learned for me, and I said I've learned a lot, and so obviously I've built my own software for this process, but literally the process of education is an important one. You need to educate yourself on the capital raising process and what you're to experience. Software plays a massive role in the analytics and confidence for you in understanding where you're at and what investors are interested in, and tracking what they're actually doing. If you don't have this, you're flying blind in the conversation, and there's no reason for you to not have it. I said it's a really simple thing that you can add to your process so that you've actually got visibility over what's going on. Process is super important. So just having education, just having software is not the same as if you add the right process to it. Having the right process that works is super important. And then obviously getting access to investors consistently, be consistently looking to attract investors to your opportunity is super powerful, and you need to be doing that. And then what you've got to do is be consistently analyzing, refining, improving, and then repeat, right? Be hard on yourself. The way you almost got to think about, like, this is your KPI. These are your KPIs to achieve. If your goal is that you want to improve your conversion rate from 1 in 20 to 1 in 5 or 1 in 10, fantastic. So you need to get the education, the software, the process, and access to the investors to actually do that, right? Those are the most important things in helping you get the outcome, get the outcome that you're after. Okay, and then the personal benefit, this is what we're all after. When we're all going to a capital raise, what we really want to have is confidence. This is everything we want to do is we just want to know that what we are doing is the email we're sending is the right type of email. The process that we're taking through is the right type of process. You want to get some sort of knowledge around the questions that they're going to be asking you before you have that conversation. You want to make sure your documentation is structured in the right way, which is interesting for them and easy for them to digest, right? It's just a game of confidence, right? Utilizing CRISP, obviously I'll just talk about this quickly, and then as soon as I finish talking about CRISP, then we'll go into the Q&A part. So please prepare any questions you may have. And I said, feel free to send them through in chat. I'm happy to answer as many questions as possible, as many as people ask. And we've obviously got a good attendance today. So the CRISP solution, my goal for you, and I just highlight about the raising capital, and just so you know, these all came from my own experience. When I first started talking about CRISP, I was talking about all the different features. And then when I got to the end of the last year, I actually realized what the real benefits of the platform was. And it was the first one is that I can actually raise capital with a level of confidence now. More importantly, I learned how to use the analytics of the platform to increase my conversion rate, right? Then I realized that I didn't take out 2 staff. It was me that was doing it. And I was actually still able to set up strategic partners. In fact, last time I raised money, I was overseas the entire time. I did it all via Google Meet, right? Because it said I set up the right process and the right framework. Right, but save your time. And it was interesting for me. I found that investors would either come on within 2 to 4 days or within 6 months. But you've got to set the process up right that you can do that. And we obviously teach our clients how to do that. And the last one is you've got to reduce the opportunity and revenue costs. These are the main benefits that I got out of the platform myself, right? And that's why, for me, it's a no-brainer as far as using it. I think anyone that's going to raise money this year should actually use CRISP for their process. And then this is the other value add, right? We don't really talk about this too much, but it's going to be something that's very big for us sort of in 2020, where we will provide you with the different templates, the education, the processes that we use ourselves and that our clients that are most successful are using, so that you can learn from them and you can adapt them to your approach, because, success creates more success, and that's what we're going for. So that company that spoke to 40 investors and didn't secure one, them going forward, they should have been converting 4 to 8 investors, right? Because they would have had the right process, right templates, right education, etc. That's what we're going for. And then the investment in CRISP is $23.88 per year. And these are the different things that you get access to. As I said, we're trying to add as much value as possible. We're not asking for a lot of money for the software. For me, I see no reason why someone wouldn't use this type of software in their actual capital raise, because the power of having effectively the ability to create an additional 500K, a million, 2 million during your capital raise, just because of having the right process, that's worth it enough. The second part, saving your time, because we're so busy doing everything else. We're meant to wear so many hats. If you can save any sort of time whatsoever, it makes a massive difference in your life. So for me, I'm always trying to think about how we can help our clients save time, save money, and improve efficiency. And then the next step, what we'll look to do is we'll look to try and create benchmarks which assist with helping you understand whether you need to slightly modify your email because you're not getting enough conversion rate from inviting to your deal room to coming in, or people in your deal room to actually converting to shareholders. We want to help people sort of understand those different metrics. And then obviously the next features coming will be related to investor relations. So you can communicate directly with all your potential investors and existing investors at once. And then obviously you'll have analytics around that. And then obviously secondary sales will be a major theme that we'll be focused on as well. All right, so actually, sorry, one final thing, Emergence 2020. After our last one, we did have a lot of people asking about, if there was if we still had opportunities available to present at Emergence. We do have some final allocations available to present at Emergence. We actually crossed 1,700 registrations for that, which is absolutely nuts. We're actually beyond the registrations we had for 2019. Emergence is the largest thing we do each year. We've made that into an experience where the first 2 days is actually workshops for you about how to raise capital, how to accelerate your growth, how to build high performance teams, and then also how to scale internationally. That's really what the content's focused around. Day 2 is really around, it's called the reverse pitch, where we're actually getting investors to talk to you about what they want to invest into. And then days 3 and 4 is the actual Emergence conference, where you can showcase your business to our attendees. You get to present for 10 minutes, and there's a whole package that goes along with that. So if you have any questions about that, feel free to email me afterwards and I'll get one of our team to supply you with more information. But Emergence is, said, if you haven't been, it's an absolute experience, right? And because we are expecting 2,000 delegates at it, it's said there's just no other conference in Australasia that achieves that sort of outcome. All right, there's my details. So I'll leave that up there. Let's get to your questions, shall we? Okay, so feel free to send through any questions that you may have. The first one is, could you talk more about the time frame, about how the time frame in place? Do you say we are closing the round in 60 to 30 days? What is the wording? Yes. Oh, how you put the time frame? Okay, sure. So basically, what I think is important is that I talked about a 6-month build up. At some stage, you will need to put a time frame. What I've done with mine is I've instituted what's called the rolling close, right? So effectively every 3 months I open up the capital raising, and then that 3-month deadline becomes the next deadline that I work towards. But at all stages, I'm consistently talking to investors, right? Because what I've learned for me is being in cap raising mode, I've got some incredible strategic relationships out of it regardless. So I've found that powerful for me in the process, and said, I think it's my mission over the next sort of 12 months to get people really comfortable with that as an outcome. But yeah, typically 30 to 60 days. What you may want to do as well is you want to build up a registration list for a 30 to 60 day period as well. So for example, if companies are talking to us about, presenting at Emergence, what I will say is they may want to launch their capital raising, like for example, the first week of April, so that what they can do is for Emergence, they can build interest, and then they can continue generating interest after the conference as well. So that by the time they actually launch their offer, they've got a significant amount of momentum going into the capital raise. So I hope that helps. And to Matt, thank you. I'm happy to share. So I'm happy to answer all your questions. So any question, don't feel said. You're writing in the chat. If you write through the chat, no one else will see it. So you don't have to worry about feeling like asking a dumb question or anything like that. I said I really want people to ask, because I said I do my best to cover as much as possible in the actual platform. In the actual presentation. but obviously you may have some additional questions. Ashley's asked about how can we get registered into the platform CRISP. So firstly, you can just register online, but following this, you can just have a discussion with one of my team, and they'll take you through the sort of the onboarding and the sign up process for the platform. Okay, great question here, Danny. I hope you guys don't mention me. I'm not going to mention any last names, by the way, just so you know. I'll just mention sort of first names. But great question. Do founders usually write their pitch decks and IMs, or do you recommend anyone to assist? I literally wrote an article on this. We've over the years we recommend to a group to do all our pitch decks. The company is called Alpha Station. They literally do nothing but pitch decks. One of the challenges, so obviously so it's a combination. I had them do my pitch deck, and then I also keep on updating it myself. One of the challenges you'll find is most people that want to do pitch decks also want to do your capital raising as well, right? So they want to talk about how they can get that sort of 6 to 8% fees of the capital raising. What we really like about Alpha Station is they just do pitch decks. That is all they do. And they're incredibly successful across private companies, listed companies, and so forth. So I suggest you at least do your business plan as a starting point. So said, I'm not a designer. I don't think, if you're doing your own, it just takes so much time unless you've got skills in doing pitch decks. I would recommend using someone else because you're busy building a business. Approximate range of costs. Typically what most people ask for is they ask for a pitch deck. They often ask for a high level IM, and they ask for an investment flyer. You can get that done for anywhere as low as, so anywhere between sort of 3 to 10K, I would say you should budget for it. If you just want a pitch deck, I think you can get that done for somewhere between 3 to 5K. For getting an IM and an investment flyer as well, you should expect anywhere between sort of 5 to 10K for getting that done. And by the way, everyone that's still on, like what's really interesting, I find what's really interesting about this end is that there's still actually literally 75% of people on the webinar are still on here. Please do ask questions. Also, feel free to add me on LinkedIn. I've put my name on there. I'm posting content very regularly, on LinkedIn just in regards to capital raising, because I said just looking to add value and going a bit deeper on the subjects. Okay, I'll be on here for 3 more minutes if you want to ask any more questions. If there's no more questions, I'll finish the webinar, but I'll make available 3 more minutes. Andrew's asked a great question. Is there anything else? Sorry, Ashley's asked a question. Is there anything else should people be aware of? Absolutely. I think from this starting point, you need to go through the actual experience, but it's the emotional part that's really the hardest part to really get your head around. It's easy for me to say it, but I tell you, when you can experience all those emotions in one day, it's about staying focused. It's about staying focused on your outcome. Also, one of the things you'll find is you get a lot of advice from people that you're not asking for in the capital raise process. It's really hard distilling what advice you should take and what advice you shouldn't take. You're going to have your own radar for that. I'll have to say, for me, I've got some horrible advice, and I've had some of the absolute best advice that's helped me shape the company in going through the capital raising process, which for me is another benefit of that consistent sort of rolling close. Great, Andrew. Happy you'll set up CRISP, and obviously the team will help you in the process, as well. Can I make the slides available? I'll make some slides available. Some of it, obviously, I retain really for our clients, because more for their process. But there will be a skeleton of the slides that I'll make available, which will effectively assist you in the process anyway. Josh, great question. So I've had a question on here from Josh asking about, can I do a presentation on how they can optimize CRISP from the investor side? Absolutely. So that's something we are looking at. So this year I've got basically 3 types of presentations I want to do. One, which is obviously like what I've just done now. The next one is more for service providers. And then the last one will be from the investor side. There's something that I'm waiting specifically for on the investor side that can add most value, but really, basically the way we've set up CRISP for you, Josh, as an investor is that effectively you can go on, you can set up your investor hub and you can put in the types of deals and you can set in the timeframes in which you want communication. So there's no curated emails, it's just based on timing. And then as relevant, and then what it does is it gives you a score as to the relevance of that deal for you based on what you put in as a high level criteria. And then over the next 12 months, we're going to expand on that criteria. So effectively where we'll get to from a platform is AI matchmaking. And that's a big focus for me. We've obviously been collecting data for the last 7 years on what investors are interested in. And so if we can, I basically want to make it as seamless as possible for you to get access to the deals that you want. Likewise, what I was talking about, I want to make it seamless as possible for the founders to basically have an open door to investors which are relevant to them. Okay, actually says last one. For amount of around, is it better to go small or just keep it open for what you need? I think you need to put your stake in the sand as far as what you're looking to raise and why. You know, it's really hard to say. I don't know. It's hard for me to answer that one properly because I just don't know your exact situation, right? I don't know whether you're a startup. I don't know whether you're sort of in growth stage. I don't know if you're thinking about this as a seed round or let's call it a bridge round. Okay, so it's a seed round. Look, it depends on, you got to understand, the more money you raise, the more dilution you're going to have. And that's really the simplest way of looking at it. You need to give yourself some metrics around, if you are going to raise, what is the milestones that you want to achieve with that money before you raise a larger amount, because then you can sort of get a perspective as to what that valuation could be around that time. And by the way, Josh, answering your question before, make sure you do set up an account on CRISP. So we basically want to build CRISP off the feedback of both companies and investors. So I don't really get sensitive if someone says, oh, this isn't, we need to improve this. I'm completely cool with that. I know we've got a framework that already works. We've obviously raised a significant amount of money for our clients already. My job is always just, I'm thinking, how can we help the ecosystem save time, save money, and improve efficiency? All right, everyone. I think we're all done with the questions for now. Really appreciate the time from everyone today in the middle of the day. Amazing, there's still got half the people still actually on the actual webinar. Once again, I'd like to say thank you for your time. We'll be communicating you information, obviously, about CRISP. We'll be setting up a capital raising discovery session with you if you want to learn more about the capital raise specifically for you guys and how to use our service. And then from there, I wish you all the best. Thank you.